You closed on your house, and about 3 weeks later, the letters started showing up. Official looking, your lender's name printed right on the envelope. Mortgage protection. Here's what almost nobody tells you. That is life insurance with a different name on the box, and the version in that envelope often pays the bank instead of your family and shrinks every single year while the price stays the same. I'm a licensed agent. Let me show you the 3 versions you'll be offered and which one actually protects the people you love. Quick housekeeping. This is education, not financial advice. Products, rates, and availability vary by state, carrier, and your health. Talk to a licensed professional about your situation. Let's go. First, why you suddenly got 12 letters. When you close on a house, that's public record. Your name, your address, your loan amount, anyone can buy that list, and plenty of companies do. So those letters aren't a warning from your lender that you need coverage. They're marketing, triggered by a database. That doesn't make them wrong. It just means nobody sat down and looked at your actual situation before mailing it. So what is mortgage protection insurance? It's life insurance. That's the whole answer. There is no separate category, no special product class. It's a life insurance policy sized around your mortgage so that if you die, the house gets paid for. The name is a marketing wrapper on a 100-year-old product. Once you see that, everything else gets easier. Now, here's the part that matters. You're going to be offered 3 different versions of this, and they are not equal. The difference between them can be tens of thousands of dollars to your family. Version 1 is the policy sold by or through your lender, often called MPI. Here's the catch, and it's a big one. With many of these, the payout goes directly to the lender to pay off the loan balance. Your family never touches the money. If your spouse would rather take the death benefit, keep making the mortgage payment, and use the rest for childcare or income or a funeral, they don't get that choice. The bank gets paid, and that's the end of it. Also, the benefit usually shrinks as your loan balance drops, but the premium typically does not. Version 2 is decreasing term. The money goes to your family, which is better, but the death benefit still steps down over the years, tracking roughly with your loan balance. Year 1, it might be $400,000. Year 20, it might be under $100,000. And in most cases, you pay the same premium the entire time. This is a real product, and it isn't a scam. It just means you're buying less and less protection each year for the same money. Version 3 is plain level term life insurance. The death benefit stays exactly the same for the whole term. 20 years in, it's still the full amount. The money goes to your family, and they decide what to do with it. Pay off the house or keep the payment and use the rest to live. Here's the part that surprises people. Level term is frequently the same price or cheaper than the decreasing policy in those letters because it's sold in a competitive market instead of a mailbox. So if you remember one thing from this video, remember this question. Who gets the check? If the answer is the bank, you didn't buy protection for your family, you bought protection for the lender's balance sheet, and you paid for it. Your family should get the money, and your family should make the decision. That's the whole difference. Let me put numbers on the shrinking problem. These are example numbers, not a quote. Say you buy $400,000 of decreasing coverage at $45 a month. 10 years in, your balance is down around $300,000, so that's what pays out. 20 years in it might be $100,000. You paid $45 a month the entire time. With level term, that same $45 a month would have kept $400,000 in force the whole 20 years. Same money, very different outcome for your family. And here's a bigger point people miss. Your family's problem isn't only the mortgage. If you die, they lose your income. There's still the car, the groceries, the daycare, the health insurance, maybe a funeral. A policy sized to exactly your loan balance and paid straight to the bank solves one line item and leaves the rest. That's why I almost never size coverage to the mortgage. There's also a piece the letters rarely mention. Many modern policies include living benefits, meaning if you're diagnosed with a serious illness, you may be able to access part of the death benefit while you're still alive. Depending on the policy and your state, that can cover treatment or replace income during the worst year of your life. Statistically, you're far more likely to face a critical illness during your working years than to die during them. So this matters more than most people realize. The honest breakdown on the mailer policies. What's good? They're easy, often simplified issue with no exam, and something is genuinely better than nothing. If you have health issues that make regular underwriting hard, a simplified policy can be a real answer. The catch. Payment often goes to the lender, the benefit usually decreases, The price is frequently higher than open market term, and you rarely got to compare carriers. So who should actually buy the mailer version? It fits if your health makes standard underwriting difficult or expensive, or if you've been putting this off for years and the simple option is the only one you'll actually finish. Coverage you own beats coverage you meant to buy. It does not fit if you're reasonably healthy, if you want your family to control the money, or if you haven't compared even 2 other quotes. 3 questions before you sign anything. 1. Who receives the death benefit, my family or the lender? 2. Does the death benefit decrease over time, and does the premium decrease with it? 3. How does this compare to plain level term from 3 other carriers? If whoever's selling won't answer all 3 plainly, that tells you what. So, here's my honest take. Getting life insurance when you buy a house is one of the smartest things you'll ever do. The timing is right, you have something real to protect, and you're probably as young and healthy as you'll ever be again. Just don't let the envelope decide what you buy. Protect the family, not the loan balance. If you want to see what level term would actually cost you compared to that letter, comment the word house, or grab my free calculator and family bank book in the description. I'll run both side by side and show you the real numbers. No pitch, no envelope. Because your family should get the check, and your family should get to decide what to do with it.